Yesterday, one of my friends hit me up and asked me, what do you think about this real estate deal? It was a multifamily property that he was looking at, so I decided to open it up and crunch some numbers, which I'm going to share with you guys here in this video. But broadly speaking, I am just not too bullish or optimistic on the real estate market at the moment. I'm really not too interested in making real estate deals. Yes, I want to get more exposure to real estate, particularly physical properties, not so much REITs, because I'm looking for leveraged exposure to that asset class. But right now, I just don't feel like it's the right time to make a deal. Now, maybe I'm right or wrong. Actually, let me know in the comments, what do you think? Is this a good time to invest in real estate? Let me know in the comments now. Personally, I don't think it is, and I'm going to explain why. Right now, the market reminds me of that quote by Buffett, "Be fearful when others are greedy." And right now it seems like fucking everybody is greedy. I know that I cannot log into my Facebook account without getting hit with a bunch of ads with people having courses on how to make money in real estate. And personally, I know two people very well that have made a ton of money in real estate, going back to, their start right after the housing crisis in 08, 09. So they probably started in 2010, 11, or 12. And I know they've done very well. But now I know that they're making more money selling their courses, and their focus is on selling their courses and their info products, than it is actually doing the real estate deals themselves, right? So when people that have made their money in real estate are now shifting to selling info on how to make money in real estate, that's kind of it's kind of a sign that things are really, really inflated. Right, so there's the Buffett mantra, be fearful when others are greedy, and it just seems to me like everybody is being greedy. But also, prices are incredibly high right now. There's no shortage of news out there talking about how much real estate prices have increased over the last year, 2 years particularly. And then there's also the pricing based on moving averages. Now, I'm a big momentum and trend investor, and that's where the majority of my research over the last 10 years has been focused. And one of the things I looked at back in maybe 2014 or 2015, so I don't have the hard numbers of my research, was the price relative to a simple moving average. In other words, how high above a moving average, or exponential moving average in some cases, was the actual price of the asset class. And one of the things I found, and this kind of sounds intuitive, but is when prices are more than, I think it was 15% above a simple moving average, the subsequent 1 year return had like an 80% chance of being a loss over the next 12 months. I don't have the hard data anymore, but that was just something that I researched before. It was, like I said, 2014, 2015, when I was doing a lot of quantitative investing research. On any asset class, broadly speaking, when the total price was above a simple moving average, an intermediate range simple moving average, I was typically using the 10-month or 12-month. There'd be a poor performance over the next 12 months. Now, that in and of itself really isn't conclusive to make investing decisions, at least in the equity market, because equity markets can do weird things. And oh, by the way, this is the VGSLX, Vanguard's real estate mutual fund here, broadly speaking, that I've pulled up. But anyways, we'll come back to this in a second. Broadly speaking, it's not something that you can use to really time the markets, because markets can go up or down. But here's the difference with real estate. Real estate markets are not as efficient as equity markets, right? The price for a single family home does not have a liquid price. It varies, and it's often the result of negotiation. Right? So with equities, you cannot negotiate on the price of an equity or the price of a index or something. It is what it is. You don't have any impact on that. Well, with real estate, you have the ability to impact the price, and the local market conditions does. And that's why I'm pulling up this chart here of simple moving averages and stuff. And we can see that for basically nearly the last year, I think for the last 8 months or so, it's been over 15%. So maybe this is an anomaly. Maybe this is not going to fit into, the data parameter, the statistic that after, 12 months of 15%, or after reaching a price performance of 15% above a simple moving average, over the next 12 months, it's negative, right? I mean, had we invested in April, it's unlikely that we're going to see a decline at this point. So anyways, it's not always accurate. But what I'm trying to make here is that you don't want to, or I don't want to say you don't want to, you're going to get a better deal on a multifamily property or any tangible property when it is not in such a rampant bull market. And therefore, you're also going to have leverage to negotiate. So for example, this deal here that my friend was asking me for, my opinion on, it's listed at $869,900. I can tell you that this seller is not going to accept a penny less than $869,900. And that's probably why it's been on the market for, I think it's been on the market for about 73 days, right? In this market, he's not. Now, if we were in not such a strong trend, if we're back here in 2017, 2018, when things are just kind of going level, this guy is more likely to accept a lower price, right? So that's why it pays more to wait with real estate to when you're not in a strong uptrending bull market. And, I'm not saying that you have to wait for prices to come down. No, but you can wait until prices are not going up as rapidly. The other factor too here when we're considering timing is interest rates, right? The Fed announced in early December that they're raising the interest rate 4 times in 2022. Well, the last time they raised interest rates was right around here in 2017, I believe, and we can see what happened. Both real estate markets and stock markets basically had a sideways to down year in 2018. So the Fed is going to face, and the markets are going to face a lot of resistance as the interest rates rise. Real estate markets are very heavily tied to interest rates, and the demand and the pricing is very connected to or responsive to interest rates. So with that in mind, and considering what happened the last time the Fed tried to raise interest rates, like they did around 2017, 2018, and then they started lowering them again to make things go back up. I just feel like real estate has a very strong headwind, and in the future, we're going to be able to get exposure to real estate, not get exposure, but be able to negotiate better prices. So yeah, this moving average and price thing and bull market thing doesn't really have much of an impact if you're investing in equities. Get your money in the sooner you can, the better. But if you're going to invest in real estate, it pays, in my opinion, to wait for a time when things slow down, and then you can come in here, make an offer of 10% less than asking price, 15% less than asking price. Maybe ask for seller financing, right? You're going to have more leverage to actually make a deal. Anyways, let's look at the numbers behind this specific deal here. So I actually crunched the numbers yesterday in an Excel spreadsheet, and fortunately I took a screenshot and sent it to my friend, but I closed out the Excel. But here's what I got. Now, before we get to the numbers, let's just kind of look at the details in here. Turnkey, fully furnished 5-unit complex on 3-lot site with gross seasonal income potential of over $10,000 per month. Okay, first thing here, they're saying potential, right? So potential, why is this not an actual number? I don't know what this means. Like, does this mean it's not rented out? It looks furnished, like it could be rented out. I just don't know why they're saying potential, right? So because it's potential, I'm not going to give a lot of credence to this $10,000 per month. Nice landscaping with 8 newly paved line parking lot, room for a future 2-2 unit with 2 parking spaces, perfect for savvy investor with rare offering of well-maintained one property rented in season and off-season to tenants. Okay, and everything else we don't really care about. With higher rental than unfurnished units. 2-bed, 2-bath, one of those units. 2 1-bed, 1-bath, and 2 1-bed, 1-bath efficiencies, community laundry room. And they stress that it's well-maintained, and in looking at the pictures, it does look well-maintained. It's got a nice roof on it. The grass looked decent. I did see a window air conditioner in one of these things. Yeah, window air conditioner right there. That's, I don't know, kind of tacky in my opinion. But overall, the property, when looking at it from the exterior, it looks like it's well maintained. This one looks like it's had a little bit of Photoshop to kind of tune up the green. Don't know, or maybe they would have taken this picture the same day they took that picture, most likely. So yeah, it looks like they've tuned up the green on it a little bit, but still, overall, for a for a multifamily, lower middle end, I guess, rental property, it looks decent. Now, one of the things that I always like to consider is the neighborhood and the area that it's located in, right? my belief is that you cannot forecast the real estate markets, but getting forecast the growth of appreciation in real estate markets, but getting a property that's in a nice neighborhood, right? Like you can tell if it's a nice neighborhood, that's going to do better and appreciate more in value. And this thing is in a pretty good neighborhood. It doesn't give the exact address, but it gives the distance relative to local schools, and it's pretty close. It's basically within 2 miles of a couple schools. And using this, I was kind of able to pinpoint there, or get a broad reference, not pinpoint, but get a broad reference of where the actual the actual location is. So it's in a good area. So I like that about this deal here. But I am a numbers driven kind of person. So I crunched these numbers right now. I first of all came up with some assumptions of what these things could rent at. The 2 unit pull in $1,600 a month, the 2 1-bedroom 1-bath units $1,200 a month, and the 2 efficiencies $900 a month multiplied out. We get that multiplied by 12. We get an annual rental income, and then I'm deducting 10% from that just for turnover, vacancy, whatever happens, right? Assuming that it's not rented out 100% of the time, it would generate rental income of $62,640 a year, right? So now we come back here, it says income potential of that gross seasonal income potential of $10,000 per month, right? So let's just say that half the year or maybe not even half the year, season, like 4 months, it's rented out at that. The other part of the year, it's struggling to be rented out, or it's not rented out. Then we get pretty close using those assumptions. We get pretty close to my assumption or my estimate, and I'm trying to find the actual image. There it is, right? So yeah, we're kind of giving a haircut over that $10,000 per month. Then we got some other expenses in here. Management, I'm estimating at $10,000. $10,000. No, not $10,000 per month. That would make us bankrupt. 10% of the actual rental income. I think that number might be a little bit low. I know in the local area, a lot of companies are doing 10% of rental income plus the first month of rent. So that would kind of make it more like, 11%, probably, maybe somewhere around there, but a little bit more than 10% is what they're going for. With insurance, I was able to pull that number somewhere out of here. I think I just took the insurance times 10. Yeah, I'm pretty sure I just took the insurance times 10 or times 12. That's based on a monthly number. The taxes, $870 times 12, got that number. And then I did bullshit in maintenance. Right? So this is going to be cutting the grass, repainting the building, fixing AC units, dealing with the tenant that needs their light bulb replaced every month. All that kind of stuff, 20%. I think a lot of real estate investors just overlook or underestimate this number. And I will say that broadly speaking, when I see numbers on real estate, people are typically overstating the income and understating expenses. They're going to underestimate management, right? Or they're just not going to assume management. They're going to self-manage it. Well, you got to fucking play manager, okay, and deal with that, right? Is your time worth more or less than the cost that it's going to cost you to have a manager in place? And personally, I don't want to be screening tenants and running ads to get these things listed and dealing with a tenant calling me when a water heater breaks or the faucet's leaking or whatever the hell the problem is. I'm a passive investing kind of dude. I don't want that headache, and for $6,200 a year, that is a relatively small amount. Insurance, property tax, we can't control those numbers, but bullshit and maintenance, I think that a lot of people are underestimating the number when they're crunching numbers here. I would say I'm being fair at 20% of income, because if one water heater goes out, and if a water heater goes out and an air conditioning system goes out, you can be at damn near this expense just on that. Like, I don't know if you've had to hire contractors recently, but they're in short supply and they're charging premium prices. I personally own and invest in home service businesses. I know what it's like firsthand, right? So a lot of people underestimate that. So that gets us to our net operating income here. We add up the expenses, we deduct them from our annual income, we get net operating income of $29,760. Then we go to our cap rate. That's one of my favorite numbers. 3.42%. And to get this, basically what we do is we take this number, $29,760, and divide it by the price that we invest in the asset. Or maybe not, this isn't, I don't want to say the price we invest in the asset, but the asset sale price, because the price we invest in the asset is kind of a weird number, right? Like if you don't pay for it in cash. You're not investing $869 into it. So yeah. So anyways, $869,000, it's spitting off 3.42% of that annually. That's going to get our cap rate. And then a mortgage with 20% down and making the payment every month based on a 20% down on that $869,900 is going to be $42,069, $42,000 basically annually. So our cash flow is going to be negative. This thing is cash flowing negative after we pay all the expenses and our mortgage. Now, that's not necessarily bad, right? Because the cash flow is the mortgage cost is basically your cost of borrowing the money. So you do have that, in this case, what is probably going to be about $700,000 somewhere else earning returns. So you do have that. But by and large, I would like to see a positive cash flow or break even after debt servicing, after paying the mortgage. And the other thing too here is the cap rate. I didn't talk much about this, but I think that's pretty low, right? So to get this to break even, you would need to have your cap rate at about 5%. And if you go back into any of these real estate investing books like Rich Dad, Poor Dad, or any of those types of books, and you look at them over the years, the ones that were published 15 or 20 years ago say target a cap rate of 10% or 10 to 12%. And over time, as these books are publishing and they publish new editions of the book, the cap rates have slowly gone down because it's harder and harder to find as people are getting into this, and particularly right now with the price of real estate investments, or with the price of real estate broadly speaking, it's really hard to find any type of cap rate, up near 10%. I have seen some multifamilies that are in the 6 to 7% range, maybe 8%. It's not totally far-fetched to find a 6 to 8% cap rate, but this cap rate here at 3.42% seems low. Now, if the numbers go up a little bit and we get this cap rate up to 5%, then this cash flow number is going to work out to about break even. The other things here, what could we do to do this, right? Well, to kind of make this happen, maybe, and based on these numbers here, this estimate, it doesn't look good, right? But what if you wanted to put sweat equity into it? That's what I'm really talking about. Right? What if you wanted to do some improvements around here to make this thing worth more or to rent more? You could do that. That would increase your rents. Obviously, you're going to have to sink money. You're going to have to sink sweat equity into it or pay somebody else to do the actual work, right? Like maybe you put a pool in that makes it more desirable. On this type of property, I don't know how desirable a pool would be. It's hard to say. I'm not too in tune with that because what I'm thinking here is, right, you got 1 bedroom, 1 bath efficiencies. Maybe these people are like traveling nurses that rent this type of place out, right? So they don't really care about the pool. Their whole focus is on working, but maybe they do care about the pool. I don't know, but still, I know from local prices. I know from a friend in the area that's gotten a pool. You're not getting a pool put on this thing for less than $100,000, right? And that maybe then you can raise your rental prices $100 a month. Is it worth it? I don't know. That's a whole nother thing. I think broadly speaking, this thing is, I'm saying that a lot, broadly speaking. But I think generally speaking, this thing is in pretty good shape. The other thing is maybe you get better than 90% occupancy. That could do it. Maybe that the rental rates in this area are higher. You can get more for the rentals than this. That would raise your cap rate. But I think I'm being pretty fair here and pretty realistic. The other thing too is maybe your bullshit and maintenance is not quite that. But I think that rolling with these numbers is a pretty fair and realistic number. Getting beyond this stuff, getting beyond these numbers or better numbers, and by better numbers I mean higher rental rates, lower BS and maintenance, or higher occupancy. I think if you get that, you would consider yourself lucky. So yeah, considering the numbers here, I don't think this is a bad deal. It's not a horrible deal. I would say that relative to the opportunities and the properties available for sale at the moment, it's probably a good deal, or it is a good deal relative to what's out there. But personally speaking, I don't like it. I think that the numbers are not really good enough to appease me. They're not really good enough to interest me. I can get better returns on my money elsewhere and in other investments. And that said, considering what I said about, be fearful when others are greedy, the state of the real estate market, and, also the interest rate climate that we're going into, I personally would not make this investment or really many real estate investments for that purpose at this time. So yeah, what do you guys think on the real estate market here? What do you think of my analysis on this deal? Let me know in the comments below.